Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer, and today we'll be looking at Brookfield Infrastructure Partners stock, ticker BIP. I think it's Canadian. This is the US listing. This came in by request down in the comments section of one of my other videos. If you have a stock you'd like me to take a look at, just drop it down in the comments section. Usually I only post stocks that are in the S&P 500 on the YouTube channel for free, and then the rest I post on Patreon, which is $5 a month. I also have a full service investing service, Cyclical Investors Club over on Seeking Alpha, and I have that link down in the description. If you join Patreon, you get a big discount to my full service if you decide to check that out. So I am going to share Brookfield on YouTube because it's a little bit of a public service announcement rather than stock analysis. And I think everybody I just think it's really just something that I want to share to think about for everybody rather than getting into the nitty-gritty details of why I've avoided this stock for years and why I will continue to avoid it. I hadn't checked in on it in a long time, but I did look at it because I've had requests, and then I noticed that the stock price had fallen a lot recently after that, and so then I understood why people were asking. Usually, when things start looking like they're getting a little cheap, then people ask me about them, which is smart, I guess. As always, this isn't individual investing advice. This is just how I analyze stocks, especially in the case of Brookfield. So I'm just going to approach this how I would approach it if I was just looking at this for the first time. The first thing I would do is look at the historical earnings, and I would note that earnings-wise, it's been very choppy. Most of the time they are profitable since 2008, but it's been pretty choppy just with the adjusted earnings. But the stock price has risen pretty steadily over most of this time. So maybe earnings aren't telling the whole story here. I'm sure that assets are a big part of this since it says infrastructure right in the title. But then the next thing I would look at is we don't actually have data that includes like a real recession here. And what I would wonder is how would this behave during an actual recession when there's real stress from various aspects, whether it's commodity prices fall, whether it's the cost of capital goes up, whether credit freezes. I mean, there's all sorts of things that can come with a good old-fashioned recession, and we don't have that data. So I would actually avoid this probably just because of that, unless all this looked very attractive in terms of earnings growth and stuff. If it looked pretty straightforward, if they were in a business that I understood, if it was like trash removal or something, and earnings grew 10% a year since this time, that would be something I'd be willing to maybe look at a proxy company to get an idea of. I probably wouldn't be too cyclical, and so I might take a stab at something like that. With this, just looking at this would probably reject out of hand, but I always like to kind of question my initial tossing the baby out with the bathwater, and I would at least go back to look and see what did the stock price do, because earnings aren't telling us anything here relative to the stock price. It just kind of does its own thing. But if we go back to the COVID decline and we look, this is a stock that lost more than 40%, and this isn't even going to be exact peak to trough here, in 1 month. So it probably really fell about 50%. Let's see, 2020, 35, did it make a new high? Yeah, it did. But yeah, it was over $30 going in, and it troughed at 15, so it lost 50% in a month. And that tells me that if there is an actual recession that's pretty bad, investors in this stock are going to face a big drawdown, most likely. Like just that little thing there, unless this is exactly COVID related, everything was to some degree, but the whole market didn't fall 50%. The market fell like 30 something. So we know this is pretty close to twice as volatile, potentially, at least 2/3 as volatile as the overall market during a drawdown. That would definitely give me the avoid right there. I would probably avoid it anyway, but we didn't have data. That's little bit of data that we do have historically is not good. But here's the kicker. Well, this stock is sort of always just puzzled me to some degree. I write for Seeking Alpha. If you go there, there were 3 sell articles written during this drop after it fell, like however far it fell here. But from the time it IPO'd in 2009 until basically this last year, there was 1 sell article written on it in 2019. Every other one, there's like 100 buy articles. Some of that's understood because the stock price has just steadily gone up, and they pay a dividend, and people love dividends. I took the dividend off here because I don't care too much about it, but you can see the steadily rising dividend. You can kind of see it down here. So, so I think people have kind of got lured in by the rising dividend and the rising stock price. And you can do that for a while until things get stressed, and then you face the consequences, right? So here's what I would say. If you really are interested in Brookfield, go read their annual report. It's 353 pages long, and over 50 of those pages are risk factors, right? And I was just looking through it, and it's just like, I'm not sure how anybody could understand. See, you have to. For me, I just lower my ego. I look at something like this and I say, I do not understand how this business actually works. I don't understand the risks. There's 50 pages of small print risk. I mean, they have to put them in there, right? But to give, and this is to give a comparison. If you take Berkshire Hathaway, which is a huge company, it's an $800 billion company. Brookfield is $14 billion, located in Bermuda, which is interesting. But it's not really it's just for tax purposes, I'm sure. But Berkshire has like 3 pages of risk factors, right? A nearly $800 billion business. This is a $14 billion business. And what is that? Like, I don't know what percentage it is. It's like single digit percent of Berkshire. And they have 50 pages of risks factors. And then 300 and something to explain to you how this all works. I mean, I don't see how anybody can honestly say they understand this business and what the risks are. So to me, it doesn't mean there's anything going wrong. It's just that you can't trust the stock price movement over a time when there hasn't really been a recession. The little hint that we saw here, the stocks that fell 50% in a month, most of those could fall 85% in a real bad recession, or 90. I mean, and I don't think the people that are buying this for the dividend understand that. I don't think any of the writers understand. Not very many will say. There are some people who maybe are an expert in this. My time is valuable. I do not want to spend. I don't even want to read 350 something pages to decide whether I want to invest in one stock when there's 50 pages of risks that who knows how would you even calculate a risk reward on that? I don't know. But so now and it's hard for me to write about these. This is why I'm just posting the video for everybody. It's hard for me to write about stocks like this in an article because the amount of work I would have to do to try, and I probably don't even have the ability to like really explain all the risks. I know I don't. Probably don't even have the ability to explain exactly what it is they're doing in all its complexity. But I can't really write an article on it. It would be about a paragraph or two long where I would say nobody really understands this. I certainly don't. And so I'm not buying it. I'm not owning it. Now that we're seeing, let's just see how far we've come down. Again, aren't in a recession. 50% again without a recession, yeah, I mean, I think this stock could fall 80 or 90%. I mean, I don't know if it will. I'm not predicting it, but there's a difference between being what you should expect and be prepared for as an owner of the stock and a prediction of when it will fall and how deep it will fall. Well, I think there's a decent chance it could fall 80%. And I don't know when that's going to happen, but it's not something I want to own unless I can predict those type of things. All right, so that's my public service announcement on Brookfield. Nothing against them personally. I just don't understand it. It's too complex for a tiny company, basically, to have. And then the relationship with everybody else and the partnership. I mean, why? Why bother with it? All right, that's enough. Have a good day, everybody. If you enjoyed this, hit the subscribe button, and I'll see you in my next video.